Hi class, welcome to chapter 2 where we'll be discussing asset classes and financial instruments. So I think this is a great introductory chapter to talk about broad parts of the markets, not only broad parts of the markets, but how we might consider investing in them, how they function, other characteristics like potentially the liquidity of the investment or the instrument, because there can be liquidity of the asset class and then there can be underlying liquidity issues of the financial instrument themselves. So this is chapter 2, just the first slide here. Some asset classes discussed right away. One would be common stock. Two would be fixed income securities. So anything from money market funds, which function similar to a savings account, to a bond market or preferred stock, are considered fixed income securities. Fixed income, little cheat here, usually provide a stable source of income that is pretty consistent, barring the fact that it does not go bankrupt. So when you own a bond, it's typically for the aspect that it's considered to be safer and that it's a binary outcome instrument, meaning it either continues to pay its debt and repay all that, or it goes bankrupt. Next, there's derivative securities, which are things like options, which I discussed in a supplemental section. Money market instruments can be considered treasury bills, certificates of deposit, commercial paper, which is short-term loans between corporations and investors, institutional and like us, bankers accepted notes and Eurodollars. There's also repo and reverse repos, brokers funds, federal funds, and LIBOR. A whole host of these things. One important characteristic, these are generally considered safer investment vehicles. So money market funds, I tend to think of similar to cash in terms of the rate of return and the safety. Just an example of what a treasury bill would look like. Commonly comes in $10,000 and $1,000 increments, and they mature over a very short period of time, 4, 13, 26, or 52 weeks. A bond will mature over, 1 year to 30 years. People like treasury bills because they're very liquid. There's no default risk, and it's sold at a discount. So the interest doesn't come, if you're getting about 2% interest, it's because you're buying it at 98 and then getting 100 for it at maturity, not investing 100 and getting to 102. So it sells at a discount. And then there's also CDs, which are like bank deposits, the ones that are locked up and long-term, won't spend a whole lot of time on this. They're FDIC insured up to the first $250,000. That's the explicit insurance. The implied insurance is that the government won't let the banks default. This is spreads on CDs and treasuries. So, what can happen is during periods of turbulence, what will happen is the spreads between the safest assets and the least safe assets increases greatly, because during periods of stress, the more troubled assets are more likely to go bankrupt. Commercial paper, I already mentioned that briefly. Their minimum $100,000 investment. Typically, it's used by institutional firms aggregating it into a fund or for a client. They're short-term in nature. They're fairly liquid, but they're unsecured, so they're a little bit. They're not backed up by an asset, but they come from very high-quality firms. Junk bonds or low-grade firms do not issue commercial paper typically. Bankers' acceptances. Purchasers authorizes a bank to pay a seller for goods at a later date. When purchaser bank accepts the draft, it becomes a contingent liability for the bank. So they actually do like some kind of draft financing. Federal funds, that's from the Federal Reserve, which we'll talk about later in the book as well. But they set the interest rate for the economy, and the interest rate really determines how expensive or cheap money is. LIBOR, they're really revamping LIBOR in this environment, so I'm not going to focus too much on using LIBOR here in this class, but it's another function similar to the Fed in terms of an interest rate setting body. Repurchase agreements or repos, that's a short-term sales of securities with a promise to repurchase at a higher price. It's effectively a collateralized loan. And these are definitely just really overnight loans. They're not long-term loans. Reverse repos, lending money, obtaining some security title as collateral. If something goes haywire with the underlying security, you could be forced to take a haircut, meaning not get the price you desired. Haircuts are a repo market's way of imposing a margin on the collateral seller. Here's a simple example. Suppose a haircut of 2% is applied to the repo trade where the market value of the collateral is 10 million. That means the seller only receives 9.8 million from the buyer, and the repo interest is calculated on that 9.8. Broker calls, call money rates apply for investment stock margin. So effectively, the stocks and margin calls happen when there's too much debt on your stock portfolio. So some investors choose to use leverage in their stock portfolios, which is called margin. So if you have $10,000 worth of investments, you probably have the purchasing power of 15,000, right? They'll let you take a loan out against your investments. The problem is if it goes down, your investments your losses are magnified as well as your gains. So it increases risk and it's dangerous. During the credit crisis, money market funds actually hit some turbulence because some of these firms that were considered safe in money market universe turned out to be not safe. Something like GE or GM or Lehman Brothers, right? That were traditionally safe firms, and credit was applied to them at safe levels, turned out they weren't so safe, right? Yields on money market instruments, not always directly comparable. Factors influencing quoting yields, par value versus investment value. Some bonds use 360-day years versus 365. And then you have to always be on the lookout for if someone's quoting you interest on a simple basis or compounded, you want to make sure you're getting like for like. Bank discount rate for a T-bill quote. So, again, this is bank. These are sold at discount. So it's just showing here the brief formula with the original 10,000 divided by the price you paid over the 10,000 multiplied by 4, right? Because this is a quarterly bill, 90-day T-bill. So you're taking 9, the 360, and you're divided by 90 to give it the annualized rate, and that annualized rate is 5%. There's a lot of assumptions baked in there that you can continue every 90 days to roll it over at the same rate. In reality, what happens is every 90 days will be a new rate. It might be higher, it might be lower. So there's no guarantee that you'll get that 5%. It's just an estimate, assuming that you can roll that 90 days over again for the same rate. Bond equivalent yield, you can't compare them directly because they use that 360 versus 365 a day basis. Return is figured in par versus price paid. Bond par value is nominal value of the bond, share of stock, or coupon as indicated in writing on the document specified by the charter. Adjust bank discount rate to make it comparable. So bond equivalent yield, 10,000 minus the price over the price, and then multiply by 365 over n. So what's saying here is that same issuance, right? 10,000 showing the T-bill, showing that same one. But with the bond equivalent yield, it goes from 5% to 5.13% because of the way it's calculated. Effective annual yield, again, is listed right here. Effective annual yield is another combination calculation. It's important that you guys know these calculations, but it's also important that you understand the concept. In the real world, you're going to have these tools and calculations done for you for the most part. So I want to focus more on the theory here and not have you grind out math problems. But you should know how some of this stuff is measured because it will impact evaluation. And we can see here using effective annual yield, which I would say is probably the most precise to the decimal place, it's giving us 5.23%. And you can see the comparison there, 5 versus 5.13 versus 5.23. What's the real difference here is one of the primary differences is the way it's compounded. And this is I would never have you memorize this Maybe for an open book exam, it'd be worthwhile. But generally speaking, this is just showing what the right instrument yield is to measure each one of these money market instruments. Money market instruments, again, is like a cash type of investment. So once you're in the investment world, from my standpoint of view, there's not a whole bunch of money market funds you're picking between. It's effectively a proxy for cash. So I don't spend a whole lot of time, figuring out what money market funds my client should be in, because they are very generic, and again, they function a lot like cash. Continuing on the bond market. Bond market is considered a fixed income instrument. There's the government issues U.S. Treasury bonds and notes. They come in different denominations, different types of interests. Some interest rates on bonds are actually variable, but we'll cover that in a little bit. And then taxation. Most bonds are taxed unless you hold them in a tax exempt account, or muni bonds. Muni bonds are tax exempt by the state. Then there's also Treasury inflation protected securities, which adjusts its price based on inflation. So if we get higher inflation, these bonds tend to do better. And I won't spend too much time on this. This is just the bid-ask spread on a typical Treasury quote. And again, unless you're working in Treasuries, and this is a pretty nuanced part of the market, this is just looks like a typical bid-ask spread chart. And it's saying the yield to maturity on the one that's highlighted for May of 2017, which when this was written, it was 3 years away. It was saying it was yielding 1% or 0.9. So if you held this for 3 years from 2014 to 2017, you would have got a 1% rate of return. Again, as I mentioned before, functions similar to a savings account. There's some agency issues in the bond market. Most are mortgage related. So you can actually buy bonds based on home loans. And these bonds based on home loans can pay higher levels of interest because there's higher levels of risk. If the homes go bankrupt or massive amounts of homeowners go bankrupt, you could lose money in these markets. And again, it's just about matching the risk and return. If you're willing to take a little bit of extra risk, the default rate on homes is actually typically and historically really low. But when you get one of these interesting blowouts like 2008, that could, definitely impact the market. Muni bonds are issued by states and municipalities. They differ from treasuries and agencies. How? Because they could be based on your local water bill, or they could be a bond associated with the funding of a new school that's funded by sales tax revenue in the city, town, or state. There's the reason why muni bonds are given a tax exempt status is that so they can compete with corporate bonds. So you might take a muni bond that is at 3.5% because it's the same thing after tax as a corporate bond at 5%. So it gives municipalities a little bit better of a deal in terms of financing. There can also be general obligation muni bonds, which are just based off the tax or revenue. There can be other muni bonds that are based on toll booth revenue, which, as you can imagine, perhaps during a pandemic, toll booth revenue might be down. And this is the formula for determining the tax equivalent yield, right? If you want to know what one you should buy, all things being equal, including the risk, should you buy the taxable bond or the tax exempt bond? This equation here will walk you through that. So again, this is another taxable yield chart. So assuming a 30% rate, a tax rate, a 4% tax exempt yield is the same as a 5.7% corporate yield. So, that can be helpful. Corporate bonds, there can be investment grade, which is high quality. So when you think about investment grade, think of, a bond for Coca-Cola. A speculative bond would actually be the bond for Netflix, and Netflix does have bonds. So a Netflix bond will pay a higher rate of interest than a typical Coca-Cola bond or one for Walmart. There's also mortgage-backed securities, which we talked about. That's backed by a pool of mortgages. They aggregate them and then pay the investors out the interest. The reason why mortgage-backed securities are attractive is because they're backed by the value of the home. And again, historically, people have not defaulted on their home loans in massive amounts historically, right? It's only in 07, 08, 09 where it was a little bit of a challenge compared to history. Mortgage-backed securities outstanding. So when the home boom was taking place, there was a lot of mortgages written. But after the crash, there was actually a shortage of those securities as home ownership declined significantly after the financial crisis. And here's the share of the fixed income market. You can see that most of the fixed income market is issued by the government, followed by federal agency sponsored, so municipalities, and then corporate, right? Those are the big three. And from an investment standpoint, that's typically what I focus on for my clients as well: corporates, munis, and treasuries. Equity securities. This is what everyone is here for, right? Capital markets, the equity markets, they represent a share of ownership, most commonly found in common stock. You have a residual claim on the company, and you have limited liability. There's also preferred stock. Preferred stock is not as common. They're issued usually to, if you have a private company and it's going to public, you might want to give your family members some kind of preferred equity that pay them out vast amount of income. Preferred stock is really a nuanced part of the market. There are a lot of stocks that pay dividends, but preferred stock and dividend paying stocks are two different categories, right? Dividend paying stocks are in the common stock category. Preferred stock do have priority over common stock in the event of bankruptcy. And then, next, there's also depository receipts, or ADRs. ADRs allow U.S. investors to buy foreign stock that's traded on another exchange. So, example, you can buy Sony. Shares of Sony are traded as an ADR, and shares of Nintendo are also traded as an ADR in the U.S. markets. Capital gains and dividend yields. Some stocks you buy because you think the price will go up. And other stocks you buy, you think the price will go up, but you're buying it more for the dividend yield. So, give you a good example. General Mills cereal, stable business, makes pet food as well as cereal, pays a dividend as the time of this recording of around 3.3%. I think it's going to do well in the pandemic. Don't get me wrong, but I'm really buying it for that 3.3% dividend yield that is pretty attractive. Think about putting money into General Mills as opposed to a bank account. If you think the stock will remain stable, you can get 3.3% annual return. Now you're going to buy a stock. Let me give you another example. Even Sony. Sony is a pretty core IT stock. Technically, actually, Sony isn't even an IT stock. It's technically considered consumer discretionary. But effectively, you're buying Sony. It pays a 1% dividend, but you're not buying it for its 1% dividend. You're buying it because you think they're going to increase market share, right? They're going to grow their product. But dividends are important. Why do companies pay dividends? I think, this is more important than looking at the formula. Eventually, as an investor, you want to get directly paid out on your investment, and that's really what a dividend is. It's a payout to shareholders. Typically, you start to pay a dividend once you don't have any more internal resources to devote cash to. So you're not doing it. Microsoft can pay a dividend here because they're huge. They're not growing as fast as they did 20 years ago because of the law of large numbers. So Microsoft pays a dividend. At some point in the future, it might be 5, 10 years away, maybe longer, maybe shorter. Expect Facebook, Google, and Amazon to pay dividends at some point. What were dividend yields, capital gains, and total return? You have to, when you're looking at a stock, I own one casino real estate company that pays a dividend of close to 7%. That's where I'm expecting most of the growth, right? If the price appreciates, that's fantastic. But again, I'm buying that one really for the big dividend, right? Dividend yield is important to know what it is. Oftentimes it's listed for you on any summary page. The dividend yield is the dividend it pays out divided by its current price. Most companies, you do want to see them maintain their dividend or increase it over time. Because if the stock price goes up, the dividend yield actually becomes smaller because it's the same payout based on the higher stock price. So you'll want to see companies who have companies that are usually healthy will increase their dividend over time. If a company cuts their dividend, that's typically a warning sign for the market and for investors that something is not going according to plans. Stock and bond market indexes. Indexes are what you hear about the S&P 500, the Russell 3000, the NASDAQ, the Dow Jones. They're meant to track returns. They're meant to track an index over time. They're meant to be comparable performance measures for managers. And they're a base case for derivatives. Like how is your investment going to do compared to the index? Is something that's very commonly asked. How do they make the index? Is it representative? Is it broad or narrow? And then how is it constructed? So most indexes are market cap weighted or market value weighted. That's the most common logical way to construct an index. So think about the S&P 500 and the NASDAQ. The biggest companies have the highest weight. Dow Jones, on the other hand, is a price-weighted index. Price-weighted indexes are pretty arbitrary, because a company can have a high stock price but not be a valuable company. Because remember, the value of the company is a stock price multiplied by all the shares. Some companies, do a stock split to make their share price seem more attractive. Again, price-weighted index like the Dow Jones. The reason why the Dow Jones is popular is because it's the oldest tracked index. The hand-picked nature of the Dow Jones, because that's what it is, it's hand-picked, the stocks that are inside it, doesn't make for an optimal index. And then equally weighted indexes are, again, not very common, like the value line index. Even, there's another index not mentioned here, the Russell 3000, which, as opposed to the S&P 500, is the 3,000th largest companies. They break the Russell 3000 into the Russell 1000 and the Russell 2000. The Russell 1000 is the 1,000 biggest. The Russell 2000 is the 2,000 smallest. But even those segments of those indexes are broken up by size. They're market cap weighted. Weighting schemes, price weighted, are computed by adding the price of the stocks and dividing by the number. Market weighted, we already went over this. Returns equal the weighted average returns of each component of security with weights proportional to the market value of that company. Equal weighted indexes, interestingly enough, are really biased towards small cap, because if market cap weighted index is based on the large, equal weighted biases the small. So when an equal weighted index starts doing better than the market weighted index, it's because small cap stocks are outperforming. The Dow Jones, again, not a great index because it's only 30 stocks. It's 30 hand-picked stocks, not an ideal index. But again, it's the most common, most seen on TV. The S&P 500 is probably a fairly representative of the U.S. Economy. The NASDAQ, the problem with the NASDAQ is that it's very focused on tech stocks and growth stocks compared to the S&P 500. The Wilshire 5000 is pretty much every stock in the index, right? Over 6,000 companies. Derivative and contingent claim assets. Security with payoff that depends on the price of other securities. So again, think about call and put options like I mentioned in the supplemental slides. Call option is the right to buy an asset at a specified price. Put option is the right to sell an asset at a specified exercise price on or before that specified date. And here's examples. I mean, funny, look at when this, it says the stock price of Apple is around where it is today, but the truth is Apple's went up about 400% since this was published, and then they recently had a stock split. So, but the call option is really a way to add leverage to your portfolio potentially. Usually you can use options to increase the risk of your portfolio, but you can also use it to decrease the risk of your portfolio. So let's look at what this says here. If the stock is trading at 101.05, you can buy a call option, right, for $6.20 that it's above $95. So the call option is going to cost you $6.20 plus the 95, so that's $101.20 to buy that call option. And that call option expires right at the end of the month. So what you're paying for is, will the stock be above 101.20 within the next 2 weeks? You're making a bet. You can also sell a call option. If you want to sell a call option, that can reduce the risk in your portfolio. But again, I discussed the options in much greater detail in that supplemental slide. So I just walked you through this. The right to buy 100 shares of stock at a stock price of 95 using the October contract would actually cost 635. The call option, that call option price is multiplied by 100 because an option contract is representative of 100 shares. So depending on how much a stock trades at will impact the cost of that option. Not whether the option is a good deal or a bad deal or cheap or expensive, but will impact the dollars you pay. It's always important to differentiate the cost of the investment versus the value of the investment. The right, using the stock options on Apple, if you think Apple's going to go down, you'd buy a put on it, and you would want to have a high degree of confidence that Apple is going down. Obviously, if this investor bet Apple was going down, they would have been very wrong. You can also use a put option to hedge your risk. Let's say you buy a stock and you're very bullish on it, but you think maybe short term it might go down because of like one bad period. You could buy a put option that's right around earnings period, and it is based on the stock going down 10%. So you could buy yourself some protection in case the stock goes lower. There's also futures contracts, which I talk about in the supplemental slides as well. Purchaser buys specified at a contract expiration at a set price. Similar, you're right, it's a financial instrument based on the price of another asset, which makes it a derivative. Futures commitment to buy or sell at a preset price. Holder has future right to buy or sell that option on the futures contract. And that's it for chapter 2. So I go into a little bit more details on the options in the supplemental slides. I think you guys will find that helpful. As always, you guys can feel free to comment on these videos or preferably directly on the message board for the class. And hope it was helpful for you, and looking forward to chatting again soon. Thanks, guys.